All right, everybody. I've got 6:30 on my clock, so I'm going to get started. I see about 20 of you guys in the meeting today, so I'm really glad to have you guys here with us tonight. Presentation tonight, Introduction to Estate and Death Tax Planning, Fundamentals, Part 1. Let me just do some housekeeping tonight for you guys. I want you guys to feel free to submit any questions you guys have by the chat function in your Zoom window. What I'm going to do is I'm going to type a message into the chat so you can see it, so you know where you can type your questions, and I'll try to get to your questions during the presentation to be helpful.
Recording in progress.
So I'm going to type a message in the chat box so you know where to type your questions. So we're recording this presentation, so just in case you miss anything, you'll be able to go to the law firm website and see a recording of this presentation later. If you've got a lot of background noise on your computer, please mute it so that way we don't, it doesn't reverberate to everybody else in the meeting. Disclaimers. I want you guys to know that this meeting doesn't create any attorney-client privilege, and a lot of the information in this meeting is very general in nature. Whenever you're talking about IRS provisions, there's general rules, and then there's a whole bunch of little exceptions. So I'm going to try to give you guys the framework for the general rule. So when you're reading on Google or the Wall Street Journal, or you're seeing news articles about the estate tax system, you kind of know the structure, but really for your specific case, you should really email an attorney here at the firm to get advice specific to your specific situation. A little bit about me here. You can see some of my credentials there. Hook 'em horns and guns up, Texas Raiders. A lot of the experience I have for doing these estate tax returns comes from working at a CPA firm for 8 years. So I'm going to try to give you the most practical advice I've got because I've done a lot of these returns before. Here's a little bit of information about our law firm here. If you haven't worked with us before, our main specialties are, you see that down there on the bottom of the slide, estate planning. So you're alive, you got wills, you want to trust, you want to talk about where your assets go when you die. We do asset protection, which is, well, now that I've got assets, how do I keep creditors from coming out of the woodwork and seizing my assets? That's things like LLC asset protection and working the exemptions under the Texas Property Code. And then what I do here at the firm, my specialty is after someone dies, what do you do with the will? What do you do with the trust? How do you carry out those instructions? Do you have to go through the court process? Do you have to file an estate tax return, which is what we're here for today? So without further ado, let's get started. Overview. We're going to talk about the two major tax systems here in America. We've got the income tax system and the death tax system. So we'll cover those real quickly. Then we'll go into depth on how the estate and death tax system works. And then hopefully, if we've got time, we'll go into some case studies. So you'll see how these things work in practice. Okay, unfortunately, there are a lot of things I won't be able to cover tonight just because there's so much stuff to cover. If you go onto Google, you will see a lot of this alphabet soup planning. Qualified personal residence trusts, SLATs and GRATs. Those kind of things we won't be able to cover tonight. One of the big things for some clients is planning with limited liability partnerships and LLCs. So those kind of things are important, but we just won't be able to cover them until I think maybe part 2 or 3. Okay, so let's talk about the United States income tax systems. So we've got two major systems. We've got the income tax system, which is a tax that you pay every year. And then you've got the federal estate and death tax system, which is a tax that you owe at death. It's a one-time tax at death. Some of y'all may be old enough to remember the Texas inheritance tax, but fortunately, that's no longer in effect for right now. Knock on wood. So let's talk about the income tax system. Income taxes are the taxes that you're used to paying every year. They're on IRS Form 1040, typically due on April 15th. They're due on things like wages, Social Security, interest, and dividends. This is where you got your standard or itemized deduction, and your tax rate really depends, for income tax purposes, on the amount of income you have in any particular year. I'm going to point out something here. The income tax system is a system that we're most used to, and I'll give you a specific example. When you have life insurance, typically the death benefit on a life insurance policy is not taxable income under the income tax system. But we'll use life insurance as an example under the death tax system on the next slide. Now, the death tax system is different. You do not pay this tax every year. The death tax system is a one-time tax that's assessed on your date of death. It is based on your net worth on the day that you die. So it's like Uncle Sam takes a snapshot of what you own. Your checking account, your savings account, your brokerage account, your IRA, your real estate takes a snapshot of your assets on the day that you die. Add up all those assets. If after taking away deductions and your estate tax exemption, you have too many assets in the eyes of IRS, then a 40% tax is assessed on it. I don't know about you guys, but a 40% tax seems kind of scary to me. So that's why we're here tonight. I also want to point out to you that even though we're talking about taxes tonight, there are a lot of non-tax considerations when you're worried about preventing Uncle Sam from taking your money when you die. So the solutions we talk about tonight, we're going to try to emphasize solutions that don't cost a lot of money, that are not too complicated, and that allow you to maintain control of your assets and allow you to change your estate tax plan if you need to. A lot of the more sophisticated and powerful tools, they're very powerful, but you lose the ability to change your mind later. Or you're stuck with a very complex system with a lot of different entities. So a lot of the tax planning we'll talk about tonight, we'll try to keep the complexity level low. Okay, so having said that, my friends, let's start talking about estate taxes. You see here on the slide 4 big components of calculating how much estate tax you owe. And these are the components that you try to wiggle and change to prevent yourself from owing estate taxes. So we're first going to talk about this first line item. What is your gross estate? So we're going to start with an example. So I'm going to be asking you questions to help out. Here is your first example. Dad passes away single. And he says, very simple case. I want to leave everything to my only daughter. Everything to my only daughter. I have a gross estate of $12 million when I die. I'm worth $12 million when I die. For this case, assume I have no deductions. I have no deductions, but I have an estate tax exemption of $11 million. So I have $12 million of assets. I have an estate tax exemption of $11 million. So I have a taxable estate of $1 million. And the estate tax rate is 40%. 40%. This is an illustration. I'm just curious to see how far along some of our participants are. How much is owed in estate taxes in this example? I have a taxable estate of $1 million, and the estate tax rate is 40% on date of death. How much do I owe in estate taxes? there is a chat box for you to give me your answers. I want to see what you guys think. I have an answer of $400,000. I have another answer of $400,000. Another $400,000. I love your answers, you guys. I'm really happy to see your answers. Okay. I see another $400,000. Yes. Yes. You guys are exactly right. And actually, I don't care if your answer is wrong or right. This helps me know if I'm giving you good examples or not. So you're exactly right. In this case, I started with $12 million when I died. I didn't have any deductions, just to keep things simple. And I had a state tax exemption of $11 million. So that left me with $1 million subject to estate taxes. If the estate tax rate is 40%, I have to cut Uncle Sam a check for $400,000 before my kids get anything. I don't know about you guys, but I don't like the idea of cutting IRS a check with that many zeros in front of the big number. So that's kind of the framework we're working with. So the gross estate is the big top line number we care about when we're doing estate tax planning. As you saw in that example above, if for tax purposes we can get our gross estate smaller, that will reduce our exposure to estate taxes. So that's why we care about how big our gross estate is. Our gross estate is the value of all of our assets on the day that he dies. I see a question from Annie. So I'm going to interrupt right here. Annie asked a question. I'm going to go back. On this question right here on this slide, she asked, will it be the same if he gives 50% to a son and 50% to a daughter? That's a very good question, Annie. Unfortunately, the way that IRS thinks is he goes, I don't care that you're how many beneficiaries you have. I assess the tax the moment you die. So even though it might be 50% to son, 50% to daughter, the tax has to be paid first, and that doesn't affect the amount of state tax due. That's a very good question, Annie. Your question addresses a gift tax issue, but it doesn't help us with estate taxes. That's a very good question. So the gross estate is the value of all our assets on the date of death. The funny thing about estate taxes is that it's a little different from income taxes. For death tax purposes, the value of your life insurance is included in your gross estate. So if you have a life insurance policy that's worth $1 million when you die, that is counted as assets that you own on the day that you died. Here is something that's really important, and I'll give you an illustration of it because it's kind of abstract right now. When you report your gross estate on your death tax return, the valuation standard is the fair market value of your assets on the day that you die. I'm going to give you an example because that's kind of abstract. Okay, here's our example. This is going to illustrate fair market value. Gerald dies owning a home. Travis County Appraisal District says for real estate taxes, it's worth $1 million. You know, there's a homestead and over age 65 exemption on it. So the taxable value is $700,000. But you talk to a realtor and the realtor says, well, I checked the comparable sales. I went around in Lakeway. I looked up floor plans that are very similar to your house that sold in the last 6 months. And I could probably sell your house for $1.2 million. No problem. For estate tax purposes, what is the value of the real estate? For estate tax purposes, what is the value of the real estate? Give me your answers in the chat box. I want to see what you guys think. I got a lot of answers in quick succession. 1.2, 1.2, Annie 1.2, Jan 1.2. Yes, you guys are all exactly right. when we say fair market value, we mean what you can actually sell it for on the open market to a willing buyer who has general information of all the facts. So you guys are exactly right. Great answers there. Now, let's use another example of the gross estate. Gerald dies owning life insurance. He's got a life insurance death benefit of $1 million. So he's dead, and the life insurance payout is $1 million to Scarlett. Now, when he bought this life insurance policy, his insurance salesman said it's not subject to income taxes. It's not subject to income taxes. And that's a true statement. That's a true statement. When Scarlett receives $1 million payment of a death benefit, if it's a normal life insurance policy, she personally, Scarlett herself, will not owe income taxes on that $1 million. However, is life insurance subject to estate taxes because the decedent had control over that money when he died? Is life insurance subject to estate and death taxes? What do you guys think? I got a yes. Thank you. Thank you, Bill. I got a yes from Gary. I got a yes from Bruce. Yes, you guys are exactly right. So this is an illustration of how the income tax and the estate tax system do not necessarily agree. So even though Scarlett does not have to report the $1 million death benefit on her personal income tax return, that doesn't help Gerald at all, because Gerald owns the life insurance policy when he dies, and on the day that he dies, it's worth $1 million, right? Because now he's dead. So assume Gerald has no estate tax exemption, no estate tax deductions, no nothing. Every dollar he owns, he has is subject to estate taxes. Assume he has a tax rate of 40%. Assume he has an estate tax rate of 40%. How much in estate taxes does he owe on $1 million? How much does he owe in estate taxes on $1 million at a 40% tax rate? And he's got no deductions and no exemptions. Mary Lou, I see 400,000. David, I see 400,000. Gary, I see 400,000. Yeah, you guys are exactly right. I really appreciate your answers. Yes, you're exactly right. So the reason I harp on this about the life insurance illustration is that later on in this presentation, we have ways, I'm saying that with a big smile on my face, we have ways of ensuring that Gerald can still control that $1 million when he dies, but he doesn't have to pay the estate taxes on it. A lot of you guys who have done estate tax planning back in the 80s probably have a life insurance trust. And that's exactly what we're going to talk about later. Okay, so we just talked about the gross estate, right? We're under this heading, estate tax components. We just talked about the gross estate. Generally speaking, for estate tax purposes, you want to make yourself look poor on the estate tax return. The next thing you want to do is you want to say, well, once I've kind of locked in the value of my estate, there's really, after I've done as much as I can, do I have any deductions against the estate tax? Just like how on income taxes you have deductions, you also have deductions on the estate tax side, but they're a little different. So let me show you. Okay, so deductions, just what you would expect. The more deductions you have, the less you pay in estate taxes. So deductions are just good all around for estate tax purposes. Now, unfortunately, with unlike income taxes, there's not quite as much play in the deduction area because your estate tax expenses, are like your medical bills and your attorney fees, and those are typically not things that you want to run up. Your debts, those are kind of, you have them or you don't, right? If you have a mortgage in your house, okay, I can deduct that on your estate tax return. But, generally, you're typically not deliberately trying to run up your debts. The two ones that really matter for estate tax purposes, that really move the needle, are charitable gifts, if you're charitably inclined, or this is the most important one. Every dollar that you give to your surviving spouse is not subject to estate taxes. So typically, if you have a professionally designed estate tax plan, you typically will not owe estate taxes when your spouse dies. If you got a married couple and one spouse dies, if it's a good plan, you never owe estate taxes on the first death, except for weird cases. It's usually on the second death. But let me give you some examples. Rick and Elsa are married. Question 1, if Rick leaves everything to his wife, so he gets a marital deduction for every single dollar he gives to his wife, does he owe estate taxes? If Rick gives everything to his wife when he dies, does he owe estate taxes? What do you guys think? I see a no. I see a no. I see a no. I got 4 no's. Yes, you guys are exactly right. On the first death, if Rick leaves everything to Elsa, it doesn't matter how much he's worth. If he's worth $20 million, but he gives all $20 million to his wife, you can avoid the estate tax on the first death. So that's usually why you don't owe estate taxes on the first death, because your estate plan usually has some form of saying, I give as much as necessary to my wife or to my husband to prevent estate taxes when I die. Here's a secondary escape from estate taxes, but it's not as common. But I'll ask you the question anyway. If Rick dies single, so he doesn't have Elsa anymore. If Rick dies single and he leaves everything to charity, does he owe estate taxes? If Rick dies single and leaves everything to charity, does he owe estate taxes? I see a no. I see a no. I see a no. Yeah, you guys are exactly right. It's the same logic. If Rick has $20 million, by default, he's subject to estate taxes. But if he gives all $20 million to a charity, he gets a deduction, a 1-for-1 deduction, a $20 million deduction, which prevents him from owing estate taxes. The reason the charitable deduction tends not to be quite as powerful is because a lot of our clients typically want to give assets to people besides charities, right? You typically have friends or family that you want, grandkids you want to leave money to. So typically, charity is a good way to get rid of some estate tax exposure. But let's say you've got young kids or young grandkids and you're worried about putting them through school. So charity is usually not nearly as powerful as the marital deduction. So where are we now? Take a look over here. We're on the estate tax components, right? We talked about the gross estate, right? We talked about the more stuff you have, the more exposure you have to estate taxes. We talked about deductions. You can deduct things like attorney's fees, medical bills, but the big ones are your marital deduction and charitable gifts. But the exemptions that we've got highlighted right here, typically when you read about estate taxes, you're typically reading about Congress, you're typically reading about Congress thinking about ways to change or modify the estate tax exemption. So let me walk you through that right now. Okay, so right here, what is the estate tax exemption? The estate tax exemption, I like to think of it as like a hurdle. If you have an estate tax exemption and your net worth is under that estate tax exemption level, you don't owe estate taxes. It's a get out of jail free card. But if you have net worth over your estate tax exemption level, let's say your estate tax exemption is $11 million, but you have a net worth of 12, well, then you've got $1 million of net worth exposed to estate taxes. So that's the idea. Estate tax exemption level is your protection level, right? You would prefer to be under it if possible so that your kids don't eat the estate tax when you die. But here's the rub, you guys. I'm sure you've seen in the table right here. The estate tax exemption level can change, and it can change a lot. Some of you guys might have been around doing estate tax planning back in the 80s. You look at that estate tax exemption level, right? $500,000. I don't know about you guys, but a lot of us are out here in Lakeway. You can probably get a house for $400,000 in Lakeway. You add an IRA on there, you add your checking and your savings account, maybe a rental house on top of that, you definitely owe estate taxes. So back in the 80s, almost every single one of our clients had to have a bypass trust and a life insurance trust just to keep Uncle Sam's mitts off their money. We're going to talk about both those later in the presentation. But then we have a real big change. If you look at 2020 right here, you have an estate tax exemption that basically goes from $500,000 to, increases by about $11 million. So we're up to 11.5. The exemption for 2021 is $11.7 million. So for a lot of people, that is enough to really, with them and their spouse, each having an exemption of $11.7 million, that prevents a lot of people from owing estate taxes. But you know what they say, nothing lasts forever, right? So there are two ways this can really go sideways on us. Right now, there are certain Democratic Party proposals to reduce the estate tax exemption to $3.5 million. So, if you go from 11 million to 3.5, you're going to capture a lot of people into the estate tax net. And even if the Democrats don't pass that policy proposal, under current law, even if current law just stays the way it is, there's a sunset provision that says, hey, you know what? On January 1st, 2026, the estate tax exemption falls back from this 11 million, right, to 5 million. There's an inflation adjustment to that 5 million, but it's 5 million, basically. Let's call it 6 if you want to. So that's a pretty drastic change. That's more than a 50% reduction right there. So that's kind of the moving part that's kind of difficult about estate tax planning right now, because we've got a big estate tax exemption right now, but it could change. But before we start talking about how we deal with the possible changes in the estate tax exemption, let's talk about what you can do with your existing exemption right now, right? Like the stuff you can do right now. So when you read about estate taxes on Google or the Wall Street Journal or Kiplinger's or whoever, they often talk about this really nice feature called portability, or the DSUE. That's just a fancy way of saying, if you're married, when you die, you can transfer your estate tax exemption to your spouse. You can transfer your estate tax exemption to your spouse. Let me give you an example. I know that's a little abstract. So Aaron dies with an estate tax exemption of $11 million. When he dies, his executor files an estate tax return that says, hey, wait a second. I want you to give all of my estate tax exemption. I want you to give all of my estate tax exemption to my wife. So let's say wife has an estate tax exemption of $11 million when she dies, and Aaron properly filed a return to give his estate tax exemption to her, right? What is her combined estate tax exemption when she dies? What is her combined estate tax exemption when she dies? I see a 22 million. 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 Yes, you guys are exactly right. That's the whole idea behind the jargon is portability, or DSUE, is that right now, when you have an $11 million estate tax exemption, if you're married, you can really have 22, because when your spouse dies, your spouse can give you guys, I'm sorry, the actuarial tables say that us guys die first. So typically it's the husband who dies first. So the husbands can give their wives the $11 million estate tax exemption, and she will combine it with hers. So she'll have a $22 million estate tax exemption. So if the law never changed, most people, a lot of people will be able to stay under the 22 million, and that's pretty good. What we will handle later in the presentation is the fact that if wife lives long enough, her estate tax exemption can be reduced by Congress. So that's the scary part right there, is that even if Aaron passes his $11 million to his wife, if she lives long enough, her estate tax exemption could be reduced from 11 to 5, for example. So we'll kind of try to deal with that later in the presentation. Great answers, you guys. Next example. So the other thing you can do with your estate tax exemption while you're alive is you can use it to make transfers to other people while you're alive. Let me give you some background here. I didn't give it to you on the slide. I think a lot of you have probably heard that of the gift tax system, where you can give $15,000 a year per person per year to somebody. Now, if you decide to give more than $15,000 per year per person, then Uncle Sam gives you two options, and you will almost certainly choose option 2. He says, okay, well, the gift tax is 40%. So if you gave more than $15,000 in a year to somebody, I want a 40% tax on each dollar over that $15,000. Okay, I don't like that. What's my other option? Your other option is you file a gift tax return that tells IRS, look, it is true that I gave more than $15,000 in this year to somebody. But, exception, but I elect to use up my estate tax exemption instead of paying you a 40% tax while I'm alive. I elect to use up my estate tax exemption instead of paying you gift taxes while I'm alive. So when you're doing big gifts to people during your lifetime, you almost always choose option 2, which is to use up your estate tax exemption while you're alive. That's abstract. Let me give you an example. Miss White has an estate tax exemption of $11 million. So just round it off. She uses up $10 million of her estate tax exemption during her lifetime to make gifts to her friends. Now, there's a little exception here. You can give as much as you want to your spouse. IRS doesn't care about that. But in this case, I designed it so that she's not giving money to her spouse. She's giving money to somebody else, right? So she's used up $10 million of her estate tax exemption. So let me ask you the first question. She starts with an exemption of $11 million. She has used up $10 million of her exemption during her lifetime. How much estate tax exemption does she have left over right now? How much estate tax exemption does she have left over right now? I see a 1 million. 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 Yes, you guys. Thank you. Thank you. That's very good. I kind of cheated over here. I'm giving you the numbers over here on the right because I'm bad at keeping track of these things. That's exactly right. 1 million. She started with 11. She used up 10. So she's got $1 million left. Now, let's assume that she dies with a net worth of $11 million. Wow, she's a rich lady. I'm not seeing her work. So she's got $11 million in the bank. And she's got an estate tax exemption of $1 million. Does her executor owe estate taxes? Does her executor owe estate taxes if she's got an exemption of $1 million and she dies worth $11 million? I see a yes. I see a yes. I see a yes from Gary, Bill, and Bruce. Yeah, you're exactly right. This is the nightmare scenario, right? You have a lot of money in the bank, but your estate tax exemption just vanished. In this case, because she used it up during her lifetime. This is a nightmare scenario. This is not what we want. So how much? So she has $10 million exposed to estate taxes. If she owes estate taxes, how much does she owe in estate taxes? How much does she owe in estate taxes? I've done the numbers for you over here on the right side. Bruce, I see $4 million. Bill, I see $4 million. Fred, I see $4 million. Gary, I see $4 million. Yes, that's exactly right. What I did, I should have put this in the slide. The estate tax rate is 40%. I'm just using 40%. So here's the calculation right here, right? She started with $11 million. She used up $10 million. So she's got an exemption of $1 million left. She's in the nightmare scenario, right? She's worth $11 million when she dies, but she's only got an exemption of $1 million. So $10 million of her net worth are subject to estate taxes at a 40% rate. Sorry, you guys, it just took a moment for me to kind of absorb that, because I imagined myself writing a check to United States Treasury for $4 million, and I did not feel good about that. So that's how our exemption matters, is if you're going to use up your estate tax exemption, we're going to try to get the most out of it when we use it. Okay, so that handles the estate tax exemption. So where are we now, right? Here's our overview. We're talking about estate tax components. The gross estate, remember, that's how much you're worth when you die. I mean, all your assets when you die. We're going to try to make that small for estate tax purposes. And there are ways to do that. We have deductions. The most important one being the deduction you get for your spouse, everything you leave to your spouse. So fortunately, we can usually delay estate taxes to the second spouse's death. We just talked about the estate tax exemption. So we talked about how you can transfer it to your spouse, how you can use it up during your lifetime, and how Congress can really just change it on you. So now let's all try to put it together with some examples and talk about how much estate tax do I owe under certain cases, so you can kind of see how these rules play out in real cases. Oh, just some background stuff about estate taxes. Here's kind of the logistics of it, right? Since you gotta die to owe estate taxes, the person who is filling out your estate tax return is your executor, right? So if you don't know who the executor on your will is, go ahead and take a look. That person's going to be talking to the CPA and the attorney to fill out the return. Remember, I think it was Annie, you asked that question earlier. Does it matter how many beneficiaries I have? IRS, when it comes to death taxes, IRS doesn't care. IRS just says, look, I'm going to look at what you're worth when you die. I'm going to apply your deductions and your exemption. Then I'm going to send you a bill. And this bill needs to be paid before your beneficiaries get anything. Because if you pay your beneficiaries first, I'm going to find them and send them the bill. And then I'm going to foreclose on their assets if they don't pay me. So you definitely want to pay the estate taxes first. IRS is not necessarily the first person on the list of people who get the first bite at your assets, but they kind of never go away. That's the problem. You can't really get rid of them. Generally, the estate tax is due 9 months after your date of death. So the reason I mentioned the 9 months after date of death is that some of you guys may own very illiquid assets. We have a lot of clients who are asset rich, say rental properties or family-owned businesses, but they're cash poor because all the money is being invested in the business, right? So we'll talk about how to deal with lack of liquidity in some of the examples. Oh, I see a notice from Annie. Annie asked, do you have to file any IRS form to transfer the unused estate tax exemption from your spouse? Yes, Annie, that's a great question. The procedural way, so Annie's question is, do you have to file an IRS form to transfer the unused exemption to your spouse? The way you do that is, Annie, let's say husband dies and you're the surviving spouse, right? What you do is within 9 months of date of death, you find an estate planning attorney or CPA, and you file an estate tax return. Almost certainly, the husband's estate plan is designed in a way that wife won't owe any estate taxes. But you still have to file the return because IRS makes you do it. But you click a box, I think it's on page 4 near the top of the return, and it says, yes, I do want portability. I do want to transfer my husband's unused estate tax exemption to me. And what happens is IRS takes that return and they go, oh, you don't owe any money to us, but you did elect to do the portability thing. So later when you die, I'm sorry, Annie, this sounds morbid, but when you die, your executor will file a copy of your husband's estate tax return with your return to show IRS, hey, wait a second. Not only does Annie have her own personal estate tax exemption, but look at this return that was filed when her husband died. He gave her $11 million of estate tax exemption. So with their exemption combined, she doesn't owe any estate taxes. So pardon my French, you give IRS the middle finger and you say goodbye, never talk to you guys again. Okay, so now let's go to your cheat sheet on estate taxes. Here's your estate tax cheat sheet right here. How do I calculate how much I owe in estate taxes? You start with your gross estate. That's all your assets valued as of date of death at fair market value. You subtract any deductions that you have. Typically, the most powerful one is if you give stuff to your spouse, but typically you'll have some incidental administration fees like medical bills and your attorney's fees, so you can deduct those. But it's typically the marital deduction that matters the most. Then you have your estate tax exemption, which also protects you from estate taxes. But remember, Congress can fiddle with that, and we'll do some examples to show you how they can fiddle with it. That equals your taxable estate. Your taxable estate, that's the number you want to have really small, if you can. And then what IRS does, it says, okay, take your taxable estate, slap 40% against it, and you need to cut me a check for that. Oh, that makes me sad. Okay, let me give you an example. The first example is the example I prefer for my clients. I'm a little biased. Mama Texas dies in 2020. She has a gross estate of $10 million. Let's assume for simplicity, she has no estate tax deductions. She has an estate tax exemption of $11 million and the estate tax rate is 40%. What is the size of Mama's taxable estate? What is the size of Mama Texas's taxable estate? What do you guys think? Oh, I hear some silence in the chat. Okay, there you guys are. I see Bruce with a 0, Bill with a 0, Mary Lou with a 0. Yes, you guys are exactly right. At this point, her estate tax exemption, Gary, yes, that's more of the engineering answer. Yes. So you could argue it's a negative 1 million, but for our purposes, her taxable estate is 0 and she doesn't owe any estate taxes. This is the example we want. We want you to not owe estate taxes at all when you die. Typically, the way we accomplish that, if you're single, is that we've somehow managed to get your gross estate to be smaller than your estate tax exemption. And there's more than one way to do it. But in this example, we said Mama Texas is single, so she only has her $11 million exemption. Typically, with a married couple, I would have filed an estate tax return for the husband and transferred his estate tax exemption to her. So she would be sitting at 22 million. So there'd be no question that she owes estate taxes. But for simplicity, she's single in this case. Very good, you guys. Glad to see the zeros on the chat screen. Let's go to another example, which I confess I have mixed feelings about. So William wins the lottery and he dies in 2020. He's a gross estate of $21 million. Assume for simplicity, no estate tax deductions, just to keep it simple. He has an estate tax exemption of $11 million. The estate tax rate is 40%. What is the size of William's taxable estate? What is the size of William's taxable estate? I see a 10 million from Mary Lou, 10 million from Gary, 10 million from Bill, 10 million from Bruce. Yeah, you guys. He has $10 million exposed to estate taxes. You guys are exactly right. So if the estate tax rate is 40%, how much does his executor need to pay to IRS? How much estate tax does he owe? I see Mary Lou with 4 million, Bruce with 4 million, Fred with 4 million. Yeah. Can you guys imagine that? I just want you to imagine you've got a checkbook in front of you, right? The first line on it is Department of the Treasury. The next line is you write out in print $4 million and no change. That's really painful. Okay, so this is the example we don't want you in. Typically, what we're going to try to do is make your gross estate smaller somehow, or try to find some way to get you a higher estate tax exemption. William is kind of tough. He's a kid. He's young. I don't know. Maybe we find him someone cute really quick. But let's do the next example. This one kind of hurts because this one could happen to a lot of us. Is assume Mama Texas dies on January 2nd, 2026. Okay. The reason I underlined January 2nd, 2026 is that's under current law, that's when the sunset kicks in. So remember, under current law, we've got an $11.7 million estate tax exemption. But on January 1st, 2026, if the law doesn't change, it sunsets from 11 to 5. It sunsets from 11 to 5. So let's look at this example here. Mama Texas has been aggressively whittling down the size of her gross estate. Let's say she's been making gifts to grandkids and stuff like that. But she's only able to get it down to 7 million. She has no estate tax deductions for simplicity. Her estate tax exemption used to be $11 million. But because of the sunset, it's now 5. Because remember, it's January 2nd, 2026. So it went from 11 to 5. Assume for now the estate tax rate is still 40%. Under this case, what is the size of Mama's taxable estate? Yeah, Mary Lou, 2 million. Gary, 2 million. Fred, 2 million. Bruce, 2 million. Yeah, do you guys see this? It's $7 million. Her estate tax exemption used to be 11. Remember in example 1? So she would not have owed estate taxes under example 1. But she lived to January 2026, and we assume the law sunsets to 5 million. So now she has $2 million exposed to estate taxes. If she's got $2 million exposed to estate taxes, how much estate tax does she owe? Gary's got 800,000. Fred's got 800,000. Mary Lou's got 800,000. Jan's got 800,000. Yeah, that's exactly right. Right? Just because she lived longer, she owes $800,000. Whereas back in the first example, she died in 2021, she owed 0. And I even assume she did the right thing. She worked really hard to reduce the size of her estate from, I think it was 11 to 7. So this is the thing that I'm kind of concerned about right here is, if we get a sunset, a lot more people are going to be exposed to estate taxes. But here's the other thing that could really throw a wrench into things. Assume Congress doesn't wait until 2026. Assume Congress just says, no, we're going to change the law right now, right? So let's say you've got a gross estate of $6.5 million. For simplicity, assume no estate tax deduction, right? Congress has reduced your estate tax exemption to $3.5 million. For simplicity, I'm still going to use a 40% rate, but I want you to know that the proposals talk about a higher estate tax rate. I think Mr. Sanders's proposal has a more than 50% rate if you're rich enough. So under these facts, what is the size of Mama's taxable estate? Gary's got 3 million. Fred's got 3 million. Bruce has got 3 million. Yeah, you guys are exactly right. So even if we reduce the size of Mama Texas's gross estate to be even smaller, Congress can reduce the estate tax exemption even faster. That doesn't make me feel good. So if she's got a gross estate, I mean a taxable estate of $3 million, how much does she owe in estate taxes? Yeah. Gary, 1.2 million. Fred, 1.2 million. Bruce, 1.2 million. Yeah. So if Congress changes the estate tax exemption to 3.5, even with how hard Mama Texas worked to get her gross estate from 11 to 6.5, she still owes estate taxes, even though she worked her butt off to get the size of her gross estate a lot smaller. So that's kind of what we're worried about is, if the estate tax exemption stays at about 11 and you're married, you've got $22 million of combined estate tax exemption. You've got a bunch of years to give away some assets to kids without using up your exemption. You can probably work with that. But if they reduce the exemption to 3.5 or to 5, things get kind of dicey for a lot of clients. So having depressed you guys, I'm sorry, I depressed myself. Having depressed my clients sufficiently, let's talk about ways to prevent us from owing estate taxes. All right, so let's talk about some strategies. I kind of obliquely mentioned this earlier, is that for a lot of people, if you've got a lot of family members, like you've got a bunch of grandkids, cousins, brothers, sisters, kids, nieces and nephews, and you want to put them all through college and you don't need the money and you're worried about owing estate taxes, remember you can give $15,000 a year per person. And so you can start whittling away. That's a good way to keep your estate from growing. And additionally, if you've got kids or nieces or nephews or grandkids who are at the point where they're beginning to attend college, you can pay for their education directly to the education provider, and you can ignore the $15,000 limit per year. You got to make the payment directly to the provider, like directly to the university or the community college or the technical school. But IRS just says, yeah, that's cool, no problem. That doesn't eat up your $15,000 per year. So if you have that kind of extended family situation and you're worried about owing estate taxes, that's usually your first line of defense right there, is you go, okay, because I can decide to stop doing that next year. I can do it this year or choose not to do it next year, and I don't have to create any strange entities to do that. The next common strategy is your DSUE planning that Annie pointed out, where you say, okay, if my husband dies, he's going to give his $11 million exemption to me. And that's pretty good as long as the exemption stays kind of high. That's pretty good if the exemption stays high. But we may not have that choice if we live long enough or if Congress changes the law on us. So what I'm going to try to illustrate tonight, I think we've got just enough time, is I think I can show you how a life insurance trust works. So let me do that. Okay, I apologize for right now. I know this is a very busy diagram right here. Let me give you the big picture first and then walk you through the steps. So remember what we talked about with Gerald before, right? Gerald owns a $1 million life insurance policy that's payable to his daughter, Scarlett. He owns it in his own name. So when he dies, his estate has a $1 million life insurance policy. So that's subject to estate taxes. If the estate tax rate is 40%, you could owe $400,000 on that $1 million life insurance policy. I'm really not excited about that. I mean, yes, you're $1 million more, but I mean, then Uncle Sam takes 40% of it. Not that great. So the idea behind an irrevocable life insurance trust is you say, whoa, wait a second. How about I get the leverage of a life insurance policy, right? Because usually you're just paying premiums, and then when you die, you get way more than you paid in, right? That's the idea. But also, can I get that death benefit without it being subject to estate taxes? And can I still control where it goes when I die, right? I'd like all three of those things. Thank you. So that's what the life insurance trust does. It says, okay, take a look at this box to the left. You got husband and wife. Let's say they've got 3 kids. They want to leave money to their kids from a life insurance policy, but they kind of don't want to pay estate taxes on it. Fair enough, right? So they hire an attorney to create a life insurance trust entity. It is an entity that is separate from them. So it will have its own checking account. It will have its own tax ID number. It will have its own governing document. That's what you hire the attorney to prepare, right? And if you want to be really safe, you say, look, neither me or my wife are the signer on this thing. The signer of this thing is my eldest child. So there's absolutely no connection for estate tax purposes between me and this life insurance policy. But between you and me, I talked to my child before I did this, so he's in on this. He knows how this is going to work. And so you write the life insurance trust so that it says, oh, okay, here's what I want you to do. I want you to go and buy a life insurance policy, right? I'm going to contribute money to the checking account of the trust, and then the trust is going to go buy a life insurance policy. Let's say it's a $1 million policy. The policy will pay when both me and my wife die. Let's just say it's a second to die policy. And so then the life insurance company, you want to know who it pays the money to? It pays it to the life insurance trust. It pays that $1 million to the life insurance trust. So guess what? The $1 million was never in your estate. You never directly owned it, right? So you don't owe estate taxes on it. Fantastic. But you know what you did do? You wrote the life insurance trust so that $1 million goes to the people that you chose beforehand, probably your kids. So you get the benefit of, I get the benefit of a life insurance policy. I control where it goes when I die, and I don't owe estate taxes on it, right? Versus, remember, here's the comparison point, versus if I own the life insurance policy in my own name, that $1 million policy, then I owe estate taxes of $400,000. So this life insurance trust in the Gerald example saves Gerald, or really Scarlett, because she's the one who inherits, $400,000. Saves them $400,000 by setting this up. So I know it's a lot of moving parts, but once you set it up, it's kind of automatic. And then you save $400,000 at death. Okay, side-by-side comparison, right? Client has a lot of real estate, right? Let's look at this example right here. I'm looking at this row right here. In this case, client owes a bunch of real estate. So all his money's tied up with the real estate. So he's asset rich, but cash poor. So the thing is, if he owes estate taxes, he doesn't really have the liquidity to pay it in 9 months because he's concerned that he might have to sell real estate at a fire sale price. That's not so great. Case A, this is this column right here. If you owe life insurance in your own name, let's say it's a $1 million policy, it's included in your estate, and you may have to pay a 40% rate on it. Case B is we use the life insurance trust, and he says, you know what? No, I will pay to set up a life insurance trust and put the life insurance, have the life insurance in the name of that trust. Because the life insurance trust is an entity that's separate from me and it controls that policy, I'm not treated as owning that policy in my gross estate when I die. As a result, my estate doesn't owe $400,000 to Uncle Sam when I die. And my eldest son, who is running the life insurance trust, can use that money to pay my estate taxes for me, so I don't have to sell real estate when I die. All right, that's the illustration. I have just used up all our time, So let me go to the questions section. I'm sorry, I'll get to the bypass trust in part 2. We just didn't have time for it. So here's my contact information right here. If you want a copy of the slide deck, shoot us an email at info@tcvlaw.com, and I'm happy to send you the slide deck. Or if you want to ask customized questions specific to your case, please give us a phone call or shoot us an email. We kind of want to help you because we're kind of in flux with that estate tax exemption. And let me take a look at the chat and see what kind of questions we got. If you need to go, please feel free to leave. I was really happy to have you guys in the presentation. So for those of you guys who have to leave, thank you very much and have a great July 4th. I'm going to take a look at the questions now. All right, I got a question from Bill. Let me take a look. What happens if the estate tax exemption changes after I've used some of it up by gifting? For example, I gifted 10 million over time while the exemption was 11 million, leaving me with the $1 million exemption. Then the exemption is reduced to 5 million. That is a very, very good question, Bill. You actually kind of anticipate, I think, part 3 of the estate tax presentation. That kind of gets into the planning for spousal lifetime asset trust. The SLAT is the acronym for that. The rule there is that I want to give you a visualization. So when you give that $10 million, right, you file a gift tax return, or your CPA does, that says, look, I gave a gift of $10 million. But at the time that I gave it, I had $11 million of estate tax exemption. So Uncle Sam looks at that and goes, okay, you have an estate tax exemption of 11, but you used up 10. So you got an exemption of 1. So you're good. I'm not going to charge you any money. Good. Fantastic. You anticipate the issue perfectly, which is fast forward to January 1st or January 2nd, 2026, and your estate tax exemption is reduced by act of Congress to 5. From what I have read, and I think this is the correct answer, and I think the regulations agree with me on this. Like, this is what I'm seeing from the regs and the other commentators, is that if you were to die in that case, your estate tax return would say, it is true that I died with my estate tax exemption on the day that I died is 5. That's true because I died in 2026. And I did also give away $10 million of stuff while I was alive. So do I owe Uncle Sam extra money because of that? And the commentators say, what you file on that return is you say, at the time that I gave that $10 million, my exemption was 11, so I'm okay. The fact that my exemption went from 11 to 5 in the future just means now that my state tax exemption is now 0. That's the answer I've been seeing, and I think that's the correct answer. But for an answer specific to your case, if that's a case that you or your friends are looking at, I would give Aaron or Mike at our office a call to have them look at your case. Okay, I got a question from Fred. Oh, Deborah, you got a question. Yours is easy. Okay, does a 401k count in your gross estate? Deborah, yes, it does. All of it, 100% of it, it counts. And it doesn't matter that it's subject to income taxes later on. Remember, the income tax system and the estate tax system are separate. Uncle Sam is just going to say, show me a monthly statement with the value of the 401k on the day you die. All of that is in the gross estate. Deborah, good question. Fred, I'm looking at your question. Any reading info for paying for college, high school tuition versus room and board? Okay, here's why I'm hesitating on that answer, Fred, is my memory is not that great on this. I know that tuition is definitely exempt from the $15 million per year. I mean, 15,000. The exempt from the 15,000 per year rule, but I have to check the regs. It's just a quick Google search. I don't remember off the top of my head if room and board counts. is under that rule. Okay. Any other questions, you guys? Any other questions? Mary, thank you. Mary Lou, thank you very much. I appreciate that. I put a lot of work into this. I'm glad that you liked it. David, yeah. So how can we get the recorded version? What I would do, David, is I'd send an email to, and I don't know if you can see it on the screen right there. It's this address right here, info@tcvlaw.com, info@tcvlaw.com. And I would email them. That'll go to the admins, and that'll say, can you send me the link to the recorded presentation when you got it? And that way you'll get the link. If you also want the PowerPoint, same thing. Email them, and then they can send it to you. Fred, thank you very much. I appreciate it. Okay, you guys. Who gets Rick Cafe after he dies? Well, my friends, that I believe that those assets are outside U.S. jurisdiction, so that's a part 5. Foreign assets get very tricky. Okay, you guys. I think I'm going to call that a wrap. I'm really glad to have had you guys at my presentation. I'm hoping that you guys have a fantastic July 4th. Happy birthday, America. Thank you very much, you guys. And I'll see you guys on the other side. Thank you very much. Bye.